All right, so just a quick overview. What we're going to go over is some of the 2021 updates and changes, like I mentioned. First couple items, we'll talk about some tax credits that were enhanced here for 2021. So the child tax credit and the child and dependent care credit. Some inflation increases, like I said, tax rates and brackets. So the inflation bumps for those. Standard deductions, where capital gains brackets fall, the updated lifetime gift exemptions and annual gift exemption amounts. Also, just a quick mention that required minimum distributions for our retirement accounts, that's back in play for 2021. That was suspended in 2020, but those are back in play here for 21. And then the employee retention credits, which was a big item thus far here in 2021. I'll talk about when that was introduced in 2020 and then kind of the changes for 2021 that are still ongoing here. And then the work opportunity tax credit, you'll see all these acronyms we have here. So required minimum distributions right above that RMD, I'll probably refer to as that. Employee retention credits, ERC, and then this work opportunity tax credit is referred to as WOTC. So us in the accounting and tax world, we really like our acronyms. So if I refer to ERC, WOTC, RMD, hopefully you know what I'm talking about. And then, like I mentioned, an update on the proposed tax legislation. So the child tax credit, this amount's been increased for 2021. So the American Rescue Plan increased the amount of the child tax credit from $2,000 to $3,600 for children under 6 and up to $3,000 for other children under the age of 18. The scope was expanded slightly. Children 17 years and older now qualify as opposed to 16 years, 16 and sorry, I think I said that wrong, 17 and younger as opposed to 16 and younger in past years. So just that extra year qualifies. The credit amounts will be made through advance payments in 2021. So something that some of you may have seen already, or a lot of people are seeing these payments being made in advance. You can opt out of that if you want to. Now that we're already nearing November, there's 2 months of these advance payments left. So what that is, individuals that are eligible for a 2021 child tax credit will receive an advance payment of the individual's credit, which the IRS will make through periodic payments. Typically, these are on the 15th of the month. The intent is to allow struggling families to receive financial assistance now rather than waiting to file their 2022 tax return to realize the benefit. But keep in mind, this advance payment's based on your prior year's income level. So you may qualify now based on that, but if your income increases in 2021 such that you're phased out of this credit, so if your income's too high, you may see yourself paying a portion of this advance payment or all of it back with your tax return. So those are the people that have typically opted out of it if they think they're going to phase themselves out of that credit. It's fully refundable. So by making that fully refundable, the intent is for low-income households to be entitled to receive a full credit benefit. So this was a significant expansion by the American Rescue Plan. It's also expanded to residents of Puerto Rico and U.S. territories, which is new for this year as well. The child and dependent care credit was enhanced pretty significantly. The maximum credit percentage increased to 50%. So for 2021, the credits allowed up to $8,000 in expenses for one child and $16,000 for more than one. So 50% of those eligible expenses, the top credit is now $4,000 for one child or $8,000 for more than one. And that as well is potentially fully refundable depending on your income level. Some inflation-based increases just to mention here. So individual tax brackets, I won't go through all these, but Just a couple items to point out here. Sorry, one second. Just realized that my slides were being stuck on the first slide. Thank you to my helper here for pointing that out. I have this on two screens and only one screen was moving. Okay, sorry about that. All right, so back to the individual tax brackets here. So I won't go through these through every amount here. I just wanted to point out a couple items. Just the level here where we jump from 12 to 22%. This is where the majority of taxpayers fall or will pay tax at this level. That's a 10% jump. So there's a pretty significant increase here. If we look at married filing joint, that's right around the $80,000 mark. So this income between $80,000 and $172,000 is taxed at an effective rate of 22%. And you can see the increases from there. But just wanted to point that one out. And then at the 37% level. So as of now, that's your income over $628,000 for married filing joint. And anything in excess of that gets taxed at 37%. So those are kind of two thresholds, if you will, that I wanted to point out. On the capital gains tax as well, similar to that, the 22% bracket amount, that threshold at 80 grand. So one thing to point out here, again, focusing at married filing joint, that long-term capital gains tax rate, so for qualified dividends and for long-term capital gains, is 0% if your income is $80,000 or less. So, going back a slide here, just to mention, right where that jumps from 12% to 22 is just about the same spot here where you phase into having to pay tax on long-term capital gains. So if you're in a down year and you have some gains you want to realize and keep yourself in that 0% bracket, that's a good planning item to take advantage of. Standard deduction, just showing comparison of last year to where we are this year. Just got bumped up here a little bit. Again, just the inflation adjustment. So for single, it's $12,550. For married filing joints, $25,100. These amounts were increased significantly with the 2017 tax changes. So what that resulted in is a lot of people having more benefit from the standard deduction versus itemizing. So less and less people are having itemized deductions. So a summary of some updates and changes here. 2021. So with HSA contributions, the annual cap on the deductible contributions that increased. So for single accounts is $3,550 to $3,600 for self coverage, and then for a family coverage account, it went from $7,100 to $7,200. So that's the maximum you can contribute to get a deduction in 2021. The gifting limits for 2021, the lifetime exemption is now $11,700,000. And the annual gifting exemption is still at $15,000. It's been at that limit for a couple of years now. As I mentioned before, the required minimum distributions, that's back in play here for 2021. So seniors who are at least 72 years old by the end of the year are required to take an RMD for 2021. The mileage rate, just to mention, that's pretty similar to 2020. It dropped from 57 cents to 56 cents per mile for businesses, and for medical mileage from 17 cents down to 16 cents. So pretty consistent with 2020. Medical expenses, 7.5% of AGI is the minimum amount you can deduct. So anything in excess of 7.5% of your AGI is potentially an itemized deduction. Business meals, just mentioning here that a change in one of the relief bills that came out related to business meals, they're now 100% deductible for costs related to food and beverages provided by restaurants. That's for 21 and 22. Charitable contributions, in 2020, there was an above the line deduction of $300. So if you don't itemize, you could still have this deduction for $300 of charitable cash charitable contributions. For 2021, they increased that to $600 for married filing joint. The Wisconsin tax rate was reduced this year. So the third bracket, it went from 6.27% down to 5.3%, so almost a 1% savings. This bracket captures income between $24,000 and $264,000 for single filers, and $30,000 and $350 for married filing joint. So again, for married filing joint, it's between $30,000 and $350,000 of income. You'll have roughly a 1% less tax rate applied to that. So that should be a good savings for the majority of Wisconsin taxpayers. And then just to mention on the Wayfair legislation, most states have finalized their adoption of the Wayfair legislation. So, with nearly every state complying in some fashion, so it's increasing filing requirements for out-of-state sellers. Moving on to the employee retention credits, so the ERCs and the work opportunity tax credits, the WOTC. So the ERCs, that was a significant credit here that began in 2020 and is now still available here in 2021. So ERC, the 2020 Employee Retention Credit is a refundable tax credit against certain employment taxes equal to 50% of qualified wages, up to $10,000 of wages per employee. And that's for wages paid after March 12th of 2020 and before January 1st of 2021. So again, that's the 2020 credit. Capped at 50% of qualified wages up to $10,000. So it's a $5,000 credit. Originally, you did not qualify for ERCs if you took a PPP loan. It was one or the other. However, this rule was later changed, and you can take both the ERC and the PPP loan. One important thing to note, though, is that you can't count the same wages for the ERC as you do for PPP forgiveness. So no double dipping, there's no double benefit there. So something to point out. So employers, including tax exempt organizations, are eligible for this credit. You're eligible if you experience either of the following: a full or partial suspension of operations of a trade or business during the calendar quarter because of a government shutdown, limiting commerce, travel, or group meetings due to COVID-19, or if you had a significant decline in gross receipts, which I'll define in a little bit here. Also, in order to realize these credits immediately, an employer can reduce the employment tax deposits that they'd otherwise make. Also, an employer's employment tax deposits, if they're not sufficient to cover the credit, the employer may get an advance payment from the IRS. So I'll go into that a little bit more detail here in a minute. So significant decline in gross receipts. So that begins on the first day of the calendar quarter of 2020, for which an employee's gross receipts are less than 50% of its gross receipts for the same calendar quarter in 2019. So that's for calculating the 2020 credit. You had to have a 50% drop in receipts in comparison to 2019. That significant decline ends on the first day of the calendar quarter following the calendar quarter in which gross receipts are more than 80% of gross receipts for that same calendar quarter in 19. So once you reach that 80% threshold, you still qualify for that quarter. It's the following quarter where that's shut off. And again, we're talking here about the 2020 credit, so capped at $5,000 per employee. The credit applies to qualified wages, including certain health plan expenses, paid during the period or any calendar quarter in which the operations were suspended. So the definition of qualified wages depends on how many employees the eligible employer has. If an employer averaged more than 100 full-time employees during 2019, the qualified wages are generally the wages, including certain healthcare costs, paid to employees that are not providing services because operations were suspended or due to the decline in gross receipts. So it's just wages you're paying for basically the employees not to work. They can't work, but you're still paying them. For employers that have 100 or fewer full-time employees during 2019, qualified wages are those wages, again, including healthcare costs, paid to an employee during the period operations were suspended or a period of the decline in gross receipts, regardless of whether the employee was providing services. So they can still be working if you're under that 100 employee threshold. So claiming the credit, in order to claim the ERC, the employer would report the total qualified wages and related health insurance costs for each quarter on their quarterly employment tax returns, which would be Form 941 for most employers, beginning with the second quarter. The credit is taken against the employer's share of Social Security tax, but the excess is refundable under normal procedures. So it's basically a refundable credit that you claim on the 941. In anticipation of claiming the credit, the employers can retain a corresponding amount of employment taxes that they'd otherwise deposit, including federal income tax withholding, an employee's share of Social Security and Medicare taxes, and the employer's share of Social Security and Medicare taxes, up to the amount of the credit without penalty. So you can basically just not remit your payroll withholding if you're expecting to have this credit. And the IRS, I guess the Social Security Administration, had kind of put a pause on penalties if you ended up being underpaid, just because this was also new. So if you have that fear of, you didn't remit enough and the credit's not going to cover it all, they had a forgiveness of penalties for that situation. So moving on into 2021, just some updates on this. So there was an increase in the maximum credit amount, an expansion of the category of employers that may be eligible to claim the credit. There's also modifications to the gross receipts test that I mentioned, so that 50% decline was changed. And there's revisions to the definition of qualified wages. So eligible employers can now claim refundable tax credit against the employer's share of Social Security tax equal to 70% of qualified wages they pay to employees after December 31st, 2020 through December 31st, 2021. So 70% of the first 10 grants, we're talking $7,000, and that's per quarter. So again, it's limited to 10,000, but that's per calendar quarter now. That's not the annual amount. So the maximum ERC that's available is $7,000 per quarter for all 4 quarters. So it's 28 grand per employee. So it's a massive credit amount. I will say one of the parts of the infrastructure bill that's being negotiated on, they're talking about removing that 4th quarter ERC. That they were kicking around this summer, and so now that we're actually in the 4th quarter, I don't know if that'll happen, but that's still on the table. So something we want to keep our eyes on. Oh, and I should mention, I thought I had this on this slide, but the decline in receipts. So in 2020, you had to show a 50% reduction in a quarter over quarter basis for 2020 compared to 19. For the 2021 credit, that was reduced to a 20% reduction. And so you compare the corresponding quarter of 2021 to 2019. And if there's a 20% reduction, then you qualify for the credit. So that was, that brought a lot more companies into play. So the work opportunity tax credits, WOTC, this is up to $9,600 per new hire in federal income tax credits to employers. It incentivizes hiring of individuals from targeted demographic groups who face barriers to gaining and sustaining employment or with special employment needs. The tax credit's calculated on wages paid to employees who have worked a minimum of 120 hours. And it ranges from $2,400 to $9,600, depending on the target group that employee is in. The credits generated through WOTC reduce the federal income tax liability for shareholders in a pass-through entity through their personal tax liability. So it's passed through, on a K-1 and a partnership or S-corp return, and the owners realize the benefit that way. And the credits can be carried forward up to 20 years. So moving on to the proposed tax legislation, there's a lot on the table, and I'm not going to go through everything. Like I said, I kind of cherry picked some of the bigger items or the just stuff that's going to impact basically everybody or a lot of taxpayers. I'm sure this is going to end up being a last minute tax law that gets passed in some fashion at the end of the year, like we've all gotten used to in the past 3-4 years. So again, this is a summary of some of the high level items. It's certainly not everything that's included, and everything is subject to change. Even the amounts I have on here have fluctuated, over the past few weeks. This is just what's currently being negotiated. So I wish we had some final amounts here, but this is currently what I know. We will go over a few of the tax rate changes here and some of the related proposals. So the progressive corporate tax rates, right now the C Corp rate is a flat 21% for all C Corps. What is being kicked around now is a progressive tax rate, which would be 18% up to a certain income threshold, 21% basically I think that's up to like $2 million or so of income, or maybe it's 5 million. And then anything in excess of that is taxed at 26.5%. This is where it's at now. Like I said, they started off negotiations by wanting to just bump it from 21 to 28%. But now we're at this kind of progressive blended rate here. I'll also go into the higher individual taxes, proposed changes on capital gains and dividends. I'm going to talk a little bit about the expansion of the net investment income tax, which is the 3.8% surcharge, which is also referred to as the Obamacare tax, related to investment income. Restrictions on IRAs, and then just to note here that they plan to expand resources for IRS enforcement for audits and compliance. So their government's getting billions of dollars to come and enhance their audits as a potential revenue raiser. So the higher individual rates that are being proposed, the revised rates enacted by the Tax Cuts and Jobs Act, TCJA, that reduced the income level, or they're talking about reducing the income levels in the lower rate brackets. So what I'll do, I'll just quick hop back to my slide here where I showed the 2021 brackets. So they want to kind of squeeze these a little bit. So when you hit this, getting into the 35% bracket is going to be at a lesser amount. And when you're at, 523,000 here, you're going to blow through the 35% bracket a lot quicker. So that's what they're talking about doing, lowering those thresholds. Back here. So the top rate would return to 39.6%, which is where it was at in 2017 and prior years before that. And it's like I mentioned, squeezing that down, that 37% rate would begin with income around 550,000 for married filing joint and 400,000 for single, which is considerably less than where it's at right now. Higher tax on capital gains and dividends. So currently, capital gains tax, the top rate's 20%, like I had in that previous table, plus the 3.8% net investment tax that I mentioned. So it's really a 23.8% top rate right now for long-term capital gains and qualified dividends. This was originally, they talked about bumping this up to the top ordinary bracket. So they wanted to bump that all the way up to 39.6. So effectively almost doubling it. In negotiations, that's been trimmed back. I don't know where that's gonna land, but as of now, what the proposed rate is for anyone with income over $400,000, they'd find themselves in a 25% top capital gains bracket, again, plus the 3.8% net investment income tax. So an effective increase of 5%. So again, I don't know where that's going to land, but that's currently what they're saying. So it's considerably less than the 39.6 that they started at. The 3.8% net investment income tax, that'll apply to most types of income. So including all businesses. Currently, the 3.8% net investment income tax applies to investments and passive income. Proposal would apply to all types of income other than wages, self-employment income, and retirement contributions. And again, the 3.8% net investment tax would impact taxpayers with $400,000 in income and more. There's also a new 3% surcharge on income in excess of there's proposed. There isn't in place yet. They're proposing a 3% surcharge in income in excess of $5 million. This would apply to all income sources, resulting in an effective top rate of 46.4% ordinary income and 31.8% capital gains. So again, if your income's in excess of 5 million, not only do all those other increases come into play, but then this 3% surcharge on that excess income would pile on top of that. This would be effective beginning with the 2022 tax year. Qualified business income deduction, which is a 20% deduction on qualified business income for most pass-through income. That was a change that was introduced in 2000, effective in 18. It was with the 2017 tax changes. So this is a 20% deduction for small business owners, owners of pass-through entities. The proposal would be to limit that annual deduction to $400,000 for single filers and $500,000 for joint filers. So effectively, the total income limit for calculating this deduction, it'd be capped at $2 million for single and $2.5 million for joint. So if you own a business that makes $5 million, your benefit or your deduction from this qualified business income deduction would be cut in half. Again, that's the current proposal. IRA restrictions. Contributions to Roth and traditional IRA accounts would be prohibited in a tax year if the total value of all retirement accounts exceeds $10 million and the taxpayer has taxable income in excess of $400,000 for single filers and $450,000 for joint filers. So the main takeaway here, so all taxpayers would be prohibited from converting traditional retirement account amounts to Roth IRA retirement accounts if any portion of the distribution being converted is after-tax contributions. So effectively, that eliminates the ability to do a backdoor Roth contribution. So if you don't qualify for a Roth, what people do is contribute to a traditional as an after-tax contribution because their income's too high to get a deductible contribution. And then they just immediately roll that traditional into a Roth. So effectively, they're just contributing to a Roth IRA. The ability to do that would be eliminated under this proposal. So those are the hot items I wanted to mention. Flew through that pretty quickly here. We've got a little bit of time, so feel free to shoot me any questions in the comment box. As legislation gets closer to passing, and when it does pass, Vrakas will be putting out some summary write-ups. We'll be sending these out in email blasts, posting them on our blog, various other outlets. So, as these changes or these proposals get formed into law and get passed, look on social media and look on our website for postings, and we'll have this summarized, and hopefully it's not all bad news for everybody. So again, thanks for joining me. Feel free to ask questions, post comments in the chat box, and I will get back to you.